And I've already partly announced our next speaker. Can I ask you, Mr. Parkinson, to join me up here? David Parkinson is Vice President of Wood Mackenzie and will now talk about the seismic shifts in the oil and gas business. A geologist by training, he's been with Wood Mackenzie as part of the upstream consulting team since 2005. He is now the lead consultant for Wood Mackenzie's exploration strategy and hosts the annual Wood Mackenzie Exploration Summit. David Parkinson, the next 30 minutes are yours.
Okay. Thank you very much, and good afternoon, ladies and gentlemen. First of all, very many thanks for being invited along this afternoon to present to this audience. As was pointed out, I am David Parkinson, Vice President, Upstream Consulting in Wood Mackenzie. For those of you who are not familiar with Wood Mackenzie, and I suspect, I'd hope, there's not too many in the audience here, we have been providing analysis, research, and consulting services to the oil and gas business globally for the last 40 years. We pride ourselves on our ability to analyze the commercial aspects of the oil and gas business and our independence and impartiality when it comes to commentating on the industry. For those of you who came along this afternoon expecting me to talk about seismic technology, changes in seismic technology, I'm afraid I'm going to disappoint you. So if you want to leave, you're welcome to now. What I'm actually going to talk about is the dramatic change that we have seen in the industry over the last 18 months. I will break my presentation broadly down into 3 areas. To look at that change and the drivers of that change as a context to the situation that we are all in today. I will look at how those changes have affected companies and the decisions that companies have had to make and continue to have to make in today's environment. And then I will touch upon what this means for the North Sea, and this will be followed on by my colleague James Webb, who will take a much more specific North Sea slant in his presentation. So, on to the depressing news. As has already been pointed out, oil prices have more than halved over the last year and a half. We had a situation in June last year with oil prices of around $100, $110 for a barrel of Brent. Today, that price is $50. There have been a number of reasons for this drop, and it's a confluence of these factors that has caused the situation that we see today. These factors are on both the demand and the supply side. If we look at the demand factors, there has been a slower than expected growth in GDP, particularly in countries like China. For example, China's growth in 2014, official figures say it was 7.4%, slightly lower than expectations. For the first half of 2015, that figure has been 7% growth. If we move on to the supply side, and I think for the majority of the upstream industry, this has been the largest change, we have seen a rapid increase in US lower 48 production. We're in a situation in January 2013 where US lower 48 production was around about 5 million barrels per day. That increased in January to 6 million barrels a day in January 2014, and then has peaked at 7.5 million barrels per day in April this year. In addition, on the supply side, in the middle of last year, we saw an additional 500,000 barrels come out of the market with supply outages that were brought back in. All of this, coupled with the decision by OPEC not to cut production to support the price, has led to this situation that we're in today. And I'd have to point out at this stage, if you're expecting a definitive answer on where the price will go at the end of this presentation, I suspect my crystal ball isn't working quite that well. What we can say is that we are still in very uncertain times for the oil and gas business. And I think this is a theme that will be mentioned many times today and leads to the overall theme around collaboration required to get through the situation that we are in. So we're quite often asked, how does this differ to previous oil price declines? What I'm showing here is some comparison to the 2008 price collapse. And I think this is a valid comparison just to explain the differences that we are seeing today and how the industry is different from even 2008. So we're only talking 7 years ago here. On the right-hand side, we've had the pace of that decline. What you can see, and this surprised me actually, is that the 2008 collapse was more rapid than the collapse that we have seen in 2014. But the big difference here has been the pace of that recovery. If we look on the right-hand side, the graph here explains why we're seeing such change. The 2008 collapse was driven by demand change off the back of the global economic crisis. If we look at the situation in 2014, we will see that there is a reduction in demand, but demand was still positive. There was demand growth in 2014 and demand growth in 2015. And this is a fundamental difference between the situation that we're in today and 2008, which means it is really supply, or more accurately, oversupply in the market that has been one of the big contributing factors. So why isn't this supply coming out of the market? And I would argue it is, but it has just taken time to come out of the market. What we are showing here is a year-on-year quarterly change in oil production. The most drastic change has been in the United States, but this has taken time to feed through. This was the big uncertainty at the beginning of the year. How flexible is United States unconventional oil and liquids production? And I think we're beginning to see an answer now. It took until April this year for company hedges, for company drilling commitments to unwind and feed through to show a supply response to the price that we were experiencing. Other areas have been able to respond rapidly, but by and large this has been deferral or delays on capital projects, and these have tended to be more in the medium to longer term. So if I were to summarize those last couple of slides, we will see the situation in 2014 and 2015, where we had supply, additional supply in the market of between 2 million barrels to 2.5 million barrels a day, at the same time where demand was somewhere less than 1.5 million barrels per day. Our expectation is that this situation will reverse in 2016 and 2017. So for a number of us in the room, this can only mean positive news. And although I said I wouldn't show the forecast, I'm going to go back on my words and show what our forecast is for the oil price, at least in the short term going forwards. Our expectation is that the supply-demand dynamics will come back into balance and that we will have to see some moderate recovery in the oil price. I think it's probably worth pointing out the uncertainties that exist on this. We are in a different time. As it's pointed out in my title for the talk, there has been a seismic shift. There has been a change in perception and a change in the industry. And this leads to a number of uncertainties, some of which we have always had, some of which are new to deal with. For example, there are uncertainties that could push the price lower. We can have weaker than expected global economic growth. And we saw the impact that that had in July of this year. We can have a lower than expected price floor on US unconventional production, bringing more supply than we expect into the marketplace. We can have an easing of supply outages There is still a very large volume of production out there that is out of the market, that could come back into the market and have a profound impact on oil and gas prices. On the upside, we could see a change in OPEC policy. There could be a decision to cut production. If OPEC cuts production, it will have an immediate effect on the oil price that we all live in. There could be the oil market expecting this supply response and pushing the price higher quicker than we expect. There could be stronger oil demand, particularly from the emerging economies, and there could also be a slowdown in supply to come back into the market. We're all talking about the flexibility of unconventional supply in the US. There is still some testing that has to be done on these drilled uncompleted wells in the US to see how rapidly that supply can really feed back into the market. So all of this leads to uncertainty in terms of the price forecast. What I think is clear, and is clear for everyone in the room, is that this seismic shift has affected everybody across the industry. And this is the second part of my talk, moving on to look at the impact that this has had on companies, company strategy, and where they are looking to invest today. This is a view of the financial position of companies prior to the price collapse in 2014. What we are showing here is the break-even Brent oil price that companies required to remain in a debt-neutral position through 2015 and 2016. What is clear from this chart is that companies were geared up to survive and flourish in a $90 world. The line for reference on here is $60 per barrel Brent. This has necessitated that the industry make drastic changes, and the industry has cut fast and deep. Some might say faster and deeper than it ever has before. When we look at the industry response, we can see this across a number of areas. Shareholder distributions have been cut. So if we look at that same group of companies, which is 40 companies analyzed in depth by Wood Mackenzie, we can see that those companies have cut dividends by $28 billion. They have cut buybacks by $20 billion. Our expectation for 2015 shareholder distribution prior to the price collapse was 25% of investment. That has now been cut back drastically. The biggest impact for the group of companies and across the industry that we have seen has been the delay, the deferral, and the cutback on capital and intensive projects. We have seen this, for this group of companies, account for $117 billion coming out of the industry. We have also seen the industry put a squeeze on costs. This has been internal costs within companies, and this is across the service sector and oil companies, with an expectation for some that costs will be driven down by 30%. I'll come back to this cost expectation later on, because I think this is one of the collaborative areas that the industry really needs to work together on. All of this has also meant that companies have had to go to get more finance. Net debt for this group of companies has gone up $66 billion. Gearings have gone up 12% to 38%. Credit is still available there. There is still a viable growth story in the oil and gas business, according to the banks. And the last resort for companies has been to dip into the portfolio to make asset sales, to get rid of projects that they deem as either non-core or too capital intensive in what has been survival mode for the industry. Okay, so this was the view we had before, with the Brent price required by these companies pre-crash. $95 on average for these 40 companies that we see here. So what has happened with all of these cutbacks, with all of these delays, the deferments, etc., etc.? What we can see now is a very different picture. The average Brent price required 2015, 2016, and this is the long-term Brent that's required by these companies, is $69 per barrel, a 28% drop from where we were 18 months ago in terms of the required price. The companies that have been able to cut the deepest and fastest has been the North American focused companies that have been able to pull out CapEx from unconventional plays. The companies that remain the most exposed are the international explorers who have capital tied up in conventional projects with high upfront capital commitments. I think what we can see here, although the industry has made cuts, there are still requirements to cut further if the oil price doesn't come back to rescue the industry. So, where could these cuts come? If we look at our discretionary spend or spend of companies on capital investments out to 2020, we can see this is the level of spend that we expect in projects that are on stream. So relatively little flexibility for companies in these projects. This is the level of spend that we see in underdevelopment projects. So these are projects that are already committed, largely have contracts in place, and will go ahead, so have limited flexibility. It is really in these last two sections where we have the uncertainty and the flexibility for the industry. This is the pre-FID projects, so the pre-final investment decision projects, and that large swathe of yet-to-drill North American positions. And you can see by 2020, the industry has the ability to take out almost another 50% of costs, if necessary. And I think this is a critical point for Europe and for the North Sea and the competitive North Sea, which I move on to my next section of slides. So if we look at the resource themes, the type of projects that will be particularly challenged from that previous slide, so we're just looking at those pre-FID and North American projects, we have built up cost curves of what Brent price is required to deliver a 15% rate of return to companies from those projects, to see which resource themes are the most robust under various price views and which will be the most challenged. As we click through this, and apologies, I'm not sure the colors are coming out well for everyone, we can see that conventional projects, 30% of conventional projects work with a long-term oil price of $65 or less. Only 20% of LNG and deep water projects work with an oil price of $65 or less. We've put Deepwater Brazil on here for an example. This is a particularly robust theme. Will survive a lot better because of its scale of the pre-salt resources. But the resources that come out as the most robust under our various forward looks are the North American unconventional gas and tight oil projects. You can see that around about 40% of these projects will work with a $65 Brent long-term price, and this is to deliver a 15% rate of return. It's not inconceivable that companies would develop these projects looking for a 10% rate of return, and in that instance, around about 60% of these projects would work. So all of this points to some of the challenges that Europe will have in remaining competitive and attracting investment into the European projects going forwards. What you can see here is the volumes of investment, that same chart that we saw before, that would work with a $65 Brent oil price. And you can see that US investments into the US dwarf investments in the rest of the world. $115 billion of capital investment works at $65 or less in the US. You compare that with the rest of the world, some $95 billion works, with Europe, $19 billion. So ensuring that Europe remains relevant and competitive against this backdrop, I think is one of the key aspects that people are here today for. So what should Europe do? I'm going to touch on 3 areas that Europe could concentrate on. My colleague James Webb, after the coffee break this afternoon, will expand on this, looking at the North Sea and what else the North Sea could do. And I think we'll hear from a number of other speakers this afternoon on some of the innovations, some of the ways that they are working with the industry. The first, and I think this was touched upon a little bit in the previous discussion, is fiscal. Ensuring that everything that can be done fiscally is being done to ensure a win-win situation for companies, and for the government, and for the public. Not relying solely on cost deflation, and Throlls pointed this out in his introductory address. It is not going to come solely from oil and gas companies squeezing the service sector harder. And the industry working together to maximize what it has. And we've already heard this afternoon some of the comments around infrastructure and the need of the industry to work better together on infrastructure. I will touch on each of these in turn. Fiscally, this is a snapshot of a collation of governments that are talking today about fiscal change. All around the world, there are a number of governments that are ensuring that their fiscal terms are fit for purpose and are appropriate for the current situation that we're in. These range from countries such as Malaysia, that is looking at terms around EOR to ensure that marginal fields are developed, incremental production and barrels are delivered, through to Iran, who is discussing terms for the potential lifting of sanctions when that might happen. We've also seen numerous instances in the North Sea, and I think some of the other speakers will touch on this, around proactive working on fiscal terms to ensure that marginal and tough fields come to market in a cost-effective, commercially viable manner, and that also companies are able to operate with their economic returns in mind. If we move on to costs, there's a lot of discussion around the requirement to go beyond just purely cost deflation in the industry. This slide is taken from a survey that we did of the industry earlier this year, asking the industry their views on cost deflation and cost decreases in the current scenario. What you can see from this is that the industry stated, or operators stated, they required cost reductions of up to 50% in some instances for projects to remain commercially viable. What we had seen to date at that time was a reduction of around about 10%. The forecast from that survey was an additional cost reduction of 12%. And I'm just a geologist, but I can work out the maths. There's something else needs to happen in the industry for that additional cost saving and commercialization to go ahead. And what the survey pointed out was 3 areas that the industry needs to work on. The first, and we can see them here in the gray bar on the right-hand side, is the optimization of development solutions. And we have seen a number of developments going ahead with that in mind in 2015. Efficiency improvements, reducing drill times, reducing downtime, and so on. Standardization of operations, drilling, facilities, subsea. All of these will require that collaboration that we are talking about between the operators, the service sector, and the governments. The final point that I want to talk about today is maximizing what is already existing and in place. This is a slide that I have stolen from some of my colleagues that comment on the UK, looking at some of the discussions and some that are happening in the UK around ensuring that they maximize what they already have to ensure the economic life of the industry. These range from resolving area issues and OPEX sharing issues with infrastructure that is required by the industry, through to the sharing of facilities, export lines, shuttle tankers, and the industry working better together, coming up with ways that new infrastructure and existing hubs work together, and if existing hubs do have to be retired, there's a pragmatic solution that doesn't take out other parts of the sector. And then the final point is working with the regulators to make sure that everything is being done in a pragmatic way, obviously with health and safety at the forefront. So in summary, I think my key takeaways today would be that there's been a confluence of factors that has led to the price situation and the situation in the industry today. But we expect that there will be an improvement in this situation over time. The industry has had to make a number of firm decisions as to where it will cut back and where it will invest. And some of those decisions are still ongoing. The viability of a number of geographies, a number of themes is still in question. And then finally, oil companies, service companies, governments need to work together to maximize and get the most out of what they have in place. Thank you very much for your time and your attention this afternoon.
Thank you. We have just a couple of minutes left before the break. And as you said, your colleague will be here to give us an even more North Sea specific talk after the coffee break. But thank you very, very much for a superbly informative discourse over some of the troubled waters we're looking at. And I have basically just one question based on one of your, or two of your slides really, about the possible rise in the oil price. I'm asking you to take out your crystal ball once again. And you also said on your last takeaway slide that the price is expected to go up. So are we looking at a cyclical development? Oil prices go up, they go down, they go up, they go down. Is that what we're looking at again? Or are we looking at a new normal?
It's a very good question, and the truthful answer is, if I could predict the oil price, I probably wouldn't be working for Wood Mackenzie. I would be on a beach somewhere. But I will try to answer your question in the best way that I can. The situation in the oil industry has always been, I guess, in this cyclical nature of the demand and the supply, and technology pushing the forefronts of what is available to meet that supply. I think the situation that we have had recently has been somewhat different from what we have seen before, just because of the sheer volume of supply that technology has unlocked in the US. So I suspect, we are probably going to go through this situation again in the coming years, but it might take a little bit longer just because of the change paradigm, because of that supply situation in the US.
And because of all the other uncertainties you mentioned. I mean, there is the growth rate in China and lots of uncertainties. You were through a lot of them.
Yes.
So to me, that indicated that we're possibly, very possibly, looking at a new normal.
Well, it seems to me you're telling me that the new normal is uncertainty in the oil and gas business. I think
no, that's not the new normal. I was thinking about the oil price.
Ah, okay. I mean, I think we have always been in this situation where there have been uncertainties around oil price. And it's no, if you look back to previous rises in oil price, it's due to speculators in the market as opposed to geopolitical or supply-demand led situations. So it's hard to say definitively that we are in a new normal, a new paradigm. I guess what I would point out is that it's the times such as this that the industry has the ability to work better together to find better solutions before we get to a situation where hopefully prices will rise and it's really commercial imperatives that take over rather than collaborative working.
Right, and as you know, you're far from over. I will invite you to sit in one of these chairs in a little while after your colleague have spoken, but thank you very, very much for now. Please give Mr. Parkinson a hand.
Thank you.
Thank you very much.